Good morning and welcome to this webcast, Gain Third-Party Intelligence, brought to you by Institute for Supply Management and sponsored by MetricStream. I'm your moderator, John YUVA. Thanks for joining us. Before we begin, let's cover a few administrative items. At the bottom of your audience console are multiple application widgets you can use. If you have any questions during the webcast, you can click on the Q&A widget at the bottom and submit your question. We will try to answer these questions during the webcast, but if we do run out of time, they all will be answered later via email. We do capture all questions. If you would like a copy of today's slide deck, it is available in the Resource List widget that looks like a green folder at the bottom of your screen. You can expand your slide area by clicking on the Maximize icon on the top right of the slide area, or by dragging the bottom right corner of the slide area. If you have any technical difficulty, please click on the Help widget. It has a question mark icon and covers common technical issues. Today's presenters are Sherry Gordon, President of Value Chain Group, a consulting firm that helps customers and their suppliers improve performance. Sherry is a leading authority on supplier evaluation and supplier performance management. She was founder and CEO of ValueEdge, a supplier performance management software firm acquired by Imtoris, now part of IBM. In addition to supply management, Sherry has a functional background in quality and materials management, and expertise and experience in supplier development, continuous improvement methodologies, and lean enterprise. She is the author of the highly regarded book, Supplier Evaluation and Performance Excellence, a guide to meaningful metrics and successful results. Sherry also serves as director on the board of ISM Supply Chain Risk Management Group. Our second presenter is Swapnil Srivastava. She is the assistant marketing manager for MetricStream. Swapnil comes with more than 5 years of experience in supplier governance. She is currently the assistant marketing manager for MetricStream. Today's seminar will focus on challenges of third-party risk management in the extended enterprise, how good supply management practices can help identify and manage supply risk, building an effective third-party management program, and technology's importance in improving third-party intelligence. Sherry and Swapnil, welcome to the program.
Well, thank you, John, and thanks for inviting us to the webinar. Welcome, everybody. So today I'm going to give the first portion of the webinar and talk about the first several items on the agenda that John mentioned. And getting started, let's just talk about let's define supply chain risk management so that we're kind of on the same page here. And as you can see, I have it as the identification, assessment, and quantification of potential supply chain disruptions. The objective is to control exposure to risk and reduce its negative impact on supply chain performance. There are many types of supply risk and many ways to approach risk. And as supply risk grows in importance as a business challenge, addressing it has been spreading beyond just early adopters. It used to be just the early adopters were looking at risk, and more information and solutions are becoming available to address supply risk identification, management, and mitigation. There are software solutions like the one you're going to hear about later. You can hire consultants, read books and articles, attend meetings, etc. But addressing supply chain risk can still be intimidating and even overwhelming to many procurement and supply management professionals. This slide here is a continuum that illustrates sources of risk and uncertainty and has them across this continuum from the controllable to the uncontrollable risks, the known unknown, and the unknown unknown. And this is a graphic that is in MIT Professor David Simke-Levy's book, Operation Rules. And I think it's a good illustration of risk and uncertainty. Some risks you can expect, and your organization can be prepared to address them. Those are the known unknown, or the known risks, such as market changes, supplier performance, forecasting accuracy. They're everyday risks that impact the supply chain and customers, and they're more immediately addressable risks that you can prepare for. but others can only be predicted to the extent that they'll probably occur. It's a matter of when, not if. So the unexpected risks, the least controllable risks, such as fires, earthquakes, epidemics, political unrest, they should be factored into the planning. But I think the important thing here is, while you should have plans to address these risks, it's important to really focus on the risks that are known risks. Don't overlook those in worrying about the big unknown risks, because these can be very critical to your business. I put this slide in here just as an example. I think it's a good graphic from Halo Solutions illustrating common risks and their financial impacts. And all of these risks can impact the supply chain in one's own company. And for example, that first one, IT and data security breaches, they've been occurring with disturbing frequency, and the impact goes beyond operations. Later on, I'm going to talk about data breaches and their cost a bit more and their impact on the whole supply chain ecosystem. This slide kind of illustrates that there's a lot of third-party data needed in order to address some of the financial impacts, such as watch lists, the Office of Foreign Assets and Control for enforcing economic and trade sanctions, things like weather and traffic for supply chain issues, monitoring social media for reputational information about your company, and demand planning. There's a whole mix of internal and external third-party information that you need. And Swapnil is going to talk about the software end of how to get that information. So here are some of the trends that are impacting risk these days, and there are quite a few things. I'm just going to highlight a few issues here. One of them is just-in-time and lean practices. They've often been misunderstood in relation to supply chain management and sometimes implemented in an improper and risky way. And in the drive to reduce inventories through just-in-time practices, some people have cut it to the bone and become more vulnerable to causing supply chain glitches down the chain. So lean supply chain should not mean anorexia, but sensibly reducing waste. Also, the intense focus on cost reduction, as customers have realized that savings from reducing costs of goods sold go straight to the bottom line, or just savings in general, the focus on cost reduction and the pressure on procurement to produce savings have intensified. This has led in part to the globalization of supply chains in search of lower-cost suppliers or lower-priced suppliers, and has created supply chains that are more complex and vulnerable to problems. It also puts suppliers under huge cost and financial pressures. Another area is economies of scale, where companies are centralizing some of their operations to get lower cost, or but it can result in less flexibility, or concentrating business among fewer suppliers to get more economies of scale and fewer transactions. Also, I just want to mention regulatory, which is very important, especially in some industries like financial services, where various bodies like the Department of the Treasury, FDIC, all of them now have regulations about addressing third parties and third-party risk, which didn't exist before. Another example is Transparency on Trafficking and Slavery Act, which requires companies to file annual reports with the FEC, trying to get them to disclose efforts to address human rights risks in the supply chain. And one example of this that you may be familiar with are the shrimp farms in Vietnam, that it was discovered that the fish that's made into fish meal at these farms was being caught by slaves, and Nestle has been trying to address this because this is part of their supply chain. So there are all kinds of regulations now that one must navigate and adhere to. So what's in your third-party ecosystem, and how can you begin to get your arms around it? This graphic here is kind of illustration of a business ecosystem, not, of course, the whole ecosystem, but just as an example. And it's a living system, a dynamic and changing system that constantly interacts with its own components and with those in the outside world. This circle shows various functions in an organization with some of the potential third-party impacts, and some of them are bullets under these organizational sections. So every element in the system can impact the whole. So just as an example, here's some potential third-party ecosystem risks. For example, let's say a supplier for transaction processing decides to get out of that business and gives its customer very little or no notice so that they can have a transition or get other support. Or let's say you're a retailer and you have an important distributor who does not provide the amount of shelf space that had been agreed upon and puts your competitor's product on it instead. Another one that I've seen is that many suppliers in lower tiers, and I talk here under sourcing, there's so many things you could put in this bullet, but I have first tier and then the subsequent end tiers beyond that, that many suppliers in the lower tiers have no process for qualifying and choosing their suppliers, leaving them, your organization and theirs, open to many risks because they may choose risky suppliers because they have no process to do this. And what's there to do about this? So there are many examples, and I think I'll move along to the next slide, but it's a very complex ecosystem, and the question is, how can you understand it, and how can you protect yourself against some of the risk issues that can arise? So there are various supply management practices that can be used to gain more intelligence about the third parties you're dealing with. And I'm going to discuss some of these basic supply management business processes with a view to preventing, avoiding, and mitigating supply risk. These processes aren't necessarily, these are not specific to supply risk, but they are processes that can definitely be used to address supply risk. So first I'll start with segmentation, which I guess I've spent a few slides on. And many of you, I have the ISM definition up here, but what you want to do is you can't look at every supplier, so you try to find those which might pose the greatest risks to your business and focus on those suppliers. Now, many of you may or may not do supply-based segmentation. I'm not sure how many of you do segmentation. I think a lot of companies do these days. But do you segment your supply base specifically for risk? It's part of normal supply-based segmentation. And it's a first critical step, and it should be an ongoing process. So let me say a little bit more about this. Segmenting suppliers by types of risk. This particular graphic just lists some of the major types of risks and the types of areas of risk, and the types of components of those risks. For example, business concentration. Sole source, of course, is something that's difficult to avoid at times, but single source may not be practical, putting all your eggs in the basket of a few sources just for efficiency. But in doing this, the most obvious high-risk third parties should be on your list, and these would be organizations that have a material impact on your organization's revenue and expenses. They're organizations that suppliers that perform core and critical functions, or perhaps they handle sensitive customer information, or they impact your ability to deliver a service or a product to a large number of customers. These are the ones you should be looking for. And there are many types of suppliers to pick during segmentation. Maybe suppliers who've exhibited poor performance, have late deliveries. They're located in politically or geographically unstable areas in the world, or new suppliers in an important category who have not established a track record with you, so you want to keep your eye on those suppliers. But this is sort of a basic place to start in what types of areas you're looking for to find potential risky suppliers. So supply chain risk management segmentation is a process where you have to understand each supply chain risk, categorize whether the risk is critical, and prioritize, because you can't address all of them at the same time. So let's say you've created a list of suppliers whom you think might pose risks. You might want to prioritize these suppliers for such items as, what's the importance of your relationship with them? Do you have a valuable relationship? What's their impact? And how much leverage do you have on these suppliers? How much trust is there? There are many dimensions to this, but it certainly should be of some interest and focus to look at these suppliers. Here are some other important considerations for segmentation. I think some of the most critical things here are to involve end users in segmentation for risk, as they know what's critical and they're aware of situations that can't be known in purchasing and supply management. Also, people tend to look at the top spend, like top 10% of spend, top 20% of spend, but it's little suppliers that you're not spending a lot of money on that can come back to bite you. And so high-value items you shouldn't limit your review to high-value items. Also, you can brainstorm about the risk possibilities in the third-party ecosystem that I touched on in the previous slide. The goal is you want to end up with a prioritized list. So that's segmentation as a process to use specifically for risk. This is supplier performance management. It can give you additional intelligence about suppliers that you can't get from other sources, and sometimes it's often the best and only risk indicator for smaller suppliers. Often publicly available information can be inaccurate and unreliable for very small suppliers. But if you use supplier performance management, regularly evaluate supplier performance, and highlight opportunities for improvement, it's a way to reduce risk. That is, making sure you don't just measure the suppliers and don't do anything. You have to incorporate the opportunities into improvement plans that are regularly reviewed to make sure that suppliers are actively addressing issues that could impact risk. So, what are some supplier-induced risks? I guess the list is endless, but I'm going to highlight a few here that I think are very important. The first one here is bankruptcy, and I think you're probably already all familiar with that, and there are many ways to find, I guess through information technology, find suppliers who are going bankrupt or in poor financial condition, and that can, as suppliers go bankrupt, you can suddenly, it can impact your ability to serve customers. Defects is another one. That creates unhappy customers. I think fraud is increasingly, there's a lot of attention now being paid to fraud because it is an increasing problem. And some of it happens within, sort of between people in your own four walls and suppliers, like payments for work that's not carried out, duplicate payments, payments for short deliveries, or no payment for free services that are being carried out. Just an example of that, there's a state senator in Massachusetts, which is where I'm based, that this guy started a relationship with a dry cleaner who was head of the local chamber of commerce. For almost 20 years, he got tens of thousands of free dry cleaning services. He's now in trouble for this, but this is something that is an example of fraud, I believe, and issues that if it were to happen within your company, there'd be big problems. There's excess inventory, of course, suppliers can put you in that position. Service issues, that's the guy on the phone there. Poor supplier performance or problems can lead to poor responsiveness to end customers and can be a risk to customer satisfaction and retention. late deliveries, of course, you all know that. This next one is now we have to worry about social media risks, where suppliers might get on social media and start complaining about your company, and you have to monitor social media for that. Many companies have people who do that kind of monitoring, or even looking for complaints about their competitors, maybe looking for competitive advantage. So there are so many. This next one, the guy with the computer, is cybersecurity, which I'm going to touch on later because this is an area that's really impacting people. So these are some supplier-induced risks that can end up reducing your competitiveness in the marketplace. And just briefly here, poor supplier performance costs money and increases risk. So these are some of the risks of poor performance or poor supplier quality, and it impacts the cost of poor quality. Usually the cost of poor quality in a company can be 10 to 25% of sales, but the cost of poor supplier quality can be a large percentage of that, up to more than half of the total cost of poor quality. So risky suppliers, poor performance costs money is the point of this and needs to be addressed. Another area that offers a lot of opportunity for preventing risk in the first place is having a good supplier qualification and selection process. It helps you identify good suppliers, and you want to be avoiding risky suppliers in the first place and not adding new risky suppliers, then trying to figure out how to deal with their impact, and ultimately you may need to get rid of them. It's an unproductive and wasteful exercise that works against all the processes that you put in place to avoid risk in the first place. So having this kind of a good, robust qualification and selection process is extremely important. So what is it you need to know to identify potential third-party risks during the qualification process? Well, as part of the process, it's good to do a risk assessment and understand some details about a supplier's business. And there are various checklists and information that you can find about this, but here are some areas that I think are important, like understanding the history of the supplier and what their experience is, how long they've been in business, who controls their business, do they have any loan arrangements, what's their legal background, their capital structure, how much subcontracting do they do, because that's going to be very important to you, is how can you be sure they're not going to subcontract out your business to an unqualified third party. So the idea is to try to uncover this stuff in the very beginning, or if you haven't done it yet, among your supply base as you go along. And you would like to know compliance with corporate laws, if that's relevant. There's so much that would be very helpful. So you have to understand what safeguards each third party has in place to prevent unauthorized access and stealing of your information or assets or your customers' information. Those are one of the critical aspects of trying to understand the risks, third-party risks. This is just a brief flow chart about the flow of what the steps are in effective third-party risk management, starting with a good process to identify risk and assess it, then prioritizing the risks that you have come up with among your suppliers, your supply base, assigning responsibility for addressing these risks, mitigation and prevention, monitoring and reporting the risks, and in the end, recovery management. And these steps are important, and there's a lot behind each of these bullets about doing this effectively. But it's assumed that you already have the organization roles and responsibilities, governance, and processes in place to be able to do this. These are kind of what's behind the scenes. But I guess what I'd like to say is don't be your own worst enemy. supply managers sometimes inadvertently create their own risks, and like going with the cheapest price or consolidating spend with an unproven supplier. And I'd just like to give an example, again, kind of local to where I live in my area. Our local paper, and this is being your own worst enemy, the Boston Globe decided they wanted to save money on distribution of the newspaper, of the physical paper newspaper. So they found a cheaper supplier. I think that ended up being the cause of this change. They just chose somebody. I don't think they had a very good due diligence process. They picked a new supplier, and all of a sudden they couldn't deliver the paper. This new supplier couldn't figure out the routes. Nobody was getting their papers. And the critical thing to the Boston Globe was that a lot of their advertising revenue was generated through the physical paper. So advertisers weren't happy about not having the paper delivered to anybody, and it got to the point where writers for this newspaper were getting out there in the middle of the night helping do the deliveries. It was a disaster every day. I get this newspaper virtually, but so I didn't experience the problems. But it took them a while to get it sorted out, and they had to get the original supplier back in to help the new supplier. It was just a complete disaster. They seem to have recovered from it, but this was the idea of going with the cheapest price and consolidating spend with a supplier that you have no idea really what their performance is going to be. They didn't do proper vetting, because that's being your own worst enemy, creating your own risks. So you need to have good business processes in place, and all stakeholders have to comply with these processes. A lot of times companies have great processes, but some people call it shelfware. They're still on the shelf. They're documented, they exist, but no one's ever followed the process. So often other functions in a company don't follow procurement processes, and they inadvertently create new risks. So you can have the processes, but they have to be in place. And even good technology and expertise sometimes can't prevent risks, even when that's in place. So I guess don't be your own worst enemy by not even having that going on. Another area that's helpful in risk preventing third-party risk is supplier site visits. And these can be done with suppliers who are finalists during the qualification process to determine their current and potential performance. And this is a chance to really get out there and have a risk checklist where you can actually see for yourself. You can get information from suppliers, but sometimes actually visiting a site is extremely helpful, or with current strategic suppliers. It can be a really useful tool in uncovering specific risks that your supplier can pose. And make sure with current suppliers that there are no new risks that have popped up when you weren't looking or weren't aware of. And by visiting, the information is less filtered, and you get to see for yourself, kind of seeing. I like to say seeing is believing. A lot of people like to say that. Another practice is supplier relationship management. That was also on my original list, which is it's a good risk prevention approach. It helps you optimize the value delivered through the relationship and over the life cycle. Helps you have a relationship so that you can improve processes between your organization and suppliers, and it helps develop the trust and the relationship to help prevent risk situations or have more insight into ones that could happen. So it's a way to reduce costs and increase efficiency beyond traditional sourcing and category management efforts. This is through establishing communication processes, like managing supplier risk and compliance by having additional visibility on key relationships through policies, processes, metrics, and tools. driving performance improvement in a transparent and sustainable manner with strategic suppliers and collaboration partners, and enabling continuous improvement operations because you have long-term relationships with these suppliers and you're more likely to have the ability to work together to improve the operations and be more efficient and prevent risk. So in supplier relationship management, it helps you align with your suppliers, and it helps, the alignment helps avoid risk. For example, the alignment of business ethics is important because if they're not in alignment, this can spell trouble and increase risk. You don't want a supplier who gets you in legal trouble or negatively impacts your reputation because of ethics issues. So these are some of the benefits of having good alignment in supplier relationship management. So here's a question. Which is the best approach with suppliers, compliance or trust? Which do you think works better? Compliance, let me say this about compliance. Compliance is extremely important. Like PCI compliance, that's the compliance that occurs with credit card when you use credit cards over the internet. It's a financial compliance. You don't want people hacking into your accounts because a company isn't PCI compliant. ISO compliance, that's another one, that passing an ISO audit. However, they can give you a warm and fuzzy feeling, but they don't necessarily guarantee security or robust processes or even best practices. It's only a starting point. Developing trust and through relationships with suppliers can be more preventive of risks. But in the end, I believe that it's the usual trust but verify. You need the compliance, but the trust adds another layer of prevention that you wouldn't get otherwise with compliance alone. So this is probably an area that you could argue and have a big discussion on, but often compliance is sometimes more aspirational than a guarantee of that things are the way they should be. So you have to be very cautious about compliance as the total answer. It's a combination of the two things. Another area, and this could be the topic of a whole webinar, is using contracts to help mitigate risks. And you can look at new contracts to make sure you identify the risks and allocate them between the parties, or reviewing your current contracts for hidden risks. So one of the areas that I think is important is contracting with a supplier, that it should include requirements for certain clauses that flow down to any allowed subcontractors for areas such as ownership of property, risk of loss or damage, limitation of liability, indemnification, insurance. There are a whole lot of things here. But if for an important subcontractor or supplier, if some of the risks don't apply to them as well, it can leave one's organization without protection if the provider has if that provider that you work with has subcontracted to yet another party, and it's kind of goes on down the line, you can be unprotected. So some of these things really need to be looked at. Contracts are a good mechanism to help mitigate risk and put protections against risks in place. Another area, of course, is risk governance. And to be effective, it should start at the top and then go broad and deep across an organization. It should be cross-functional, involve people within your organization, and it's a formal approach to risk identification and mitigation. Sometimes people in supply management, people say the word supply risk, supply chain risk, and they think, oh, that's the purchasing department or that's the supply chain manager's area. It's not us. But it has to be done as an overall corporate, it's sort of a basic requirement to have governance in place to help everybody participate in risk management and add their information to the overall knowledge in the company. And here's briefly a structure that starts at the top with the CEO and the C-level suite, and it starts with the multifunctions on the right, reporting all the way up to the top, where you have risk owners. This is just one structure. There are many structures, but the whole point of this is that everybody in all functions are giving input to all aspects of risk: supplier risk, supply chain risk, compliance, all these other areas of enterprise risk. It's a corporate-wide initiative. It's not just the purchasing department's responsibility. It can't be done by purchasing alone. So these are 5 ways to deal with the risks. You can mitigate it, which is reducing the likelihood that risk will occur, or reducing the impact if it does occur. You can avoid, you can transfer the risk, make someone else be responsible. You can avoid it, like don't use the supplier. Accept it, like if a volcano erupts, nothing much you can do about it except the plans you can do to mitigate the problems. Or share risk through contracting mechanisms. But no matter what you do about this with contracts, whatever, you actually cannot outsource risks. I think that your organization is going to be held accountable. You can't outsource the associated third-party risk no matter what you choose to do. I think the focus on costs has created an environment in which many companies and their suppliers don't consider the business and operational risks of some low-cost options. So they don't look at that sufficiently, and sometimes lose sight of the fact that you can outsource services, you can outsource products, but you can't outsource the risks. You retain the risks. And I think one example I'd just like to talk about briefly, because I mentioned how security breaches have been such a problem, and they seem to happen every other day and can probably hit your own credit card. You're probably familiar somewhat with the story of Target and the Black Friday breach that affected 40 million of their customers. Where they stole that. It impacted 70 million customers. 40 million, I think, just lost their credit card information. But this all happened in the most sort of backdoor way that takes a lot of controls in place to prevent. Basically, I don't know if you're aware that it happened through a mechanical subcontractor. One of their employees at the subcontractor opened an email, a phishing email, and some bot got unleashed in this subcontractor's system where it was able to steal information from the system. And this somehow got into this subcontractor was working with Target, and somehow their breach became Target's breach. And then you've probably read all the bad stuff that ensued. But the interesting thing, besides costing Target, the year financially and millions of dollars in fees, and trying to, make all their customers whole again and get their reputation back, what I have read is that the service level agreement with this particular mechanical contractor allowed them only $300 in restitution. So in the end, they were stuck holding the tab for the whole thing, and the supplier that made it happen really didn't have any big financial liability for it. So that is one of the problems about outsourcing and the security of your information from people who have no intention of stealing your information, but somebody somehow breaches their system. So here's a little questionnaire about the barriers to supply chain risk management. It's food for thought. Yes isn't always the correct answer here, by the way. For example, the second one, does senior management focus on immediate ROI, only on immediate ROI? And sometimes you have an issue where management doesn't see supply chain risk management as something they want to invest money in. I think there's a lot more awareness now and a lot more understanding that this needs to be focused on. But these are some questions to ask. I have asked this of people in the past, and some people get depressed because their organization is not really supporting the effort. But I think more and more as people become aware of the importance of this and how much it costs not to do it, how much the cost to the business is and the risks are, that people will be able to answer these questions successfully in a way that makes sense for supply chain risk management. So before I turn this over to Swapnil, just want to make a comment about many of you probably already have some basic software applications that you're already using. Now, these are not necessarily, they're not specifically for supply risk at all, but there are aspects of them that can be used for supply chain risk management if you do have these things. And I'm not going to go over all the details of this. I'll let Swapnil talk about how to use technology for learning more about suppliers or gaining third-party intelligence. But for example, Spend Analytics can help you do that that segmentation in order to identify and manage risk. It's a good starting point for segmentation, and it helps you really slice and dice your suppliers to look at things such as single source suppliers, geographically risky locations, suppliers on whom you're really dependent, or where there's currency risk or exchange rate volatility. It helps you put processes in place in these areas of qualification, performance management, contract management. All of these things are all areas that technology can help you scale rather than just trying to, developing relationships with suppliers is definitely a plus and should be part of the equation and part of of good practices, but you can ratchet it up a lot better and scale it with technology. So that concludes my portion of the webinar, and I'd like to turn it over to Swapnil. Thank you.
Thanks, Sherry. That was very interesting, and we see ourselves a lot of cases in manufacturing, retail, life sciences, as well as banking and financial industries, oil and gas, and so on and so forth, where supplier relationship management is essential for collaboration and managing their impact to your business and making your business a success. Now, with the increase in regulatory scrutiny and continuing cost pressures, active investors, and a lot of vigilance from the public, business today needs to have a clear understanding of the risks that are not only inherent to the business but also due to the externalities. And by recognizing and proactively addressing these third-party issues, business leaders and organizations can reduce the exposure to risk and also achieve a stronger relationship with service providers, third parties, suppliers, delivery partners, and so on. And the result would be a nimbler, more responsive, and more profitable organization. So, I think that is. So, a question that we ask a lot of organizations is, how seriously is your company treating the risk of, let's say, IT compliance, bankruptcy, quality-related risks, logistics, delivery, etc. And there are various departments within an organization that manage each of these parameters. Post that, have you done due diligence on all your vendors and third parties and partners? How do you do your risk assessments and your due diligence? Is it based on the segmentations of the suppliers? If then how do you segment the suppliers? So each and every incident that is faced by the supply chain has a devastating impact in terms of the reputation of the organization as well as the trust that you have, that the customers have on you. And it takes time and resources to deal with these fallout. And the true cost of a serious incident is really hard to calculate. And more often than not, these are the challenges that we see are faced by various organizations. Number one is the visibility across the value chain, and that is where most organizations look for some solutions where they can gain visibility. Then there is the contractual risk, the risk of suppliers not and third parties not meeting the contractual obligations. Of course, insufficient due diligence done prior to onboarding as well as during onboarding or on a continuous basis. The due diligence can be financial, operational, legal, ethical, CSR, and so on and so forth, which is a primary challenge. And as I mentioned before, there's disintegrated risk assessment and scoring across departments. And that's where a lot of organizations are not really able to assess the true commitment that a supplier has to your organization and the real scores and the performance status of a third party to your organization. So most organizations do not adequately address the risk management involving third-party relationship until a problem has already arisen. And that is where it becomes essential that a technology solution helps you, enables you to capture multiple types of assessments, multiple types of information from within your organization, from outside your organization like suppliers, and also certain external databases like Dow Jones. It should help you to manage this information. It should help you screen and onboard, manage your contracts, due diligence, and continuous monitoring, and also help you in managing risk assessments, your performance, and your third-party intelligence. And also over and above this, audit is another part of third-party management, which also is required for a technology to manage. Coupled with that, security and permissions are essential because with the type of cybersecurity breaches that are in existence, it is essential that relevant permissions are granted and there is relevant security that the technology offers to your organization. Of course, to simplify any process, be it third-party management or any other, there is the need to have automated workflows where you can streamline, segment your supplier base, and then streamline the kind of assessments that need to be done on an ongoing basis, the kind of approvals that would be needed, and with this all would be automated by the workflows. And of course, with the ease of access, there's a data browser and calendar and reports and dashboards, and of course, alerts and notifications, which help your organization manage various types of third-party management issues in a streamlined fashion. So the need is to standardize and connect your third-party management processes across your organization. Here is a sample third-party management process. What we see a lot of organizations do in various scattered formats is that they have a large database of third parties, and they also onboard new third parties. They do an initial screening or an ongoing basis screening where they request for information, they purchase a contract, they define a unique ID, you have a company profile, you determine the key risk area, information security, privacy, anti-bribery, adverse media, and so on. And based on that, you trigger the appropriate assessments based on the initial score. So this is how a good technology solution will help you manage this entire process, and it would trigger appropriate assessment type like information security. If the association of that business to your organization is related to primarily information security information, then appropriate assessments would be triggered on that. If there is some ethical business assessment that you need to do and adherence to certain ethical nature to your organization, certain types of assessments would be triggered. Anti-bribery, an inherent risk that is specific to your organization based on the location, geography, country, so on and so forth. Based on that, you can qualify a third party as well. So there are various components that I listed out in the beginning of the presentation, where I spoke about the various components of a third-party management program. So screening and due diligence is one of the key steps that an organization needs to follow. And what leading firms we have seen are doing is a risk-based approach to third-party screening, as Sherry mentioned herself. A continuous and ongoing monitoring is needed to ensure ongoing compliance. Now, compliance to your internal policy or external policies or regulatory requirement, it can be, it is essential to do it on a continuous basis. And of course, there is a need to ensure full audit and tracking procedures. Now, the tool should be able to help you manage this audit requirement as well, and also capture all aspects of your relationship, connect screening to a broader process and workflow. So what should you ideally be screening for other than the information that you receive from within the tool as well? That is global sanctions list, that dozens of key global lists, global regulatory law enforcement watch list, and so on and so forth. Added to that, it is important that the tool helps you manage screening and information management. How does it do that? So a good third-party solution provides a single integrated system and ensures the data is accurately propagated across the system and organization. That is what I talk about. It gives you the visibility that is needed. It should capture information via surveys or risk assessments, and all this should be visible to the appropriate person. We see in a lot of examples, in a lot of cases, where companies need integration with external sources to enable validation of supplier information, like financial, legal, or CSR. Also, a lot of organizations need suppliers to access and suppliers to push information like documents, access performance matrices. So a web-based portal which can help suppliers across the globe access and conduct a supplier self-service with updation of information or documents and contracts. And of course, the information also talks about tracking and monitoring third-party certifications and regulatory requirement, as well as third-party and vendor contract and service level agreements. So a lot of organizations, of course, managing contracts is one of the key elements of third-party and supplier management, and therefore appropriate technology solution should help you manage contract compliance, that is, manage contracts and other documents for each product and service along with its expiry dates as well as key SLAs, and link it to the master service agreement with multiple SOWs. Now, this helps you this gives you that visibility to manage supplier compliance's various supply compliance statuses. I just made some changes to my voice. I guess there was some problem with hearing me. I hope it's better now. So going on to the next point, we see a lot of organizations requesting for reliable information for choosing the right supplier. So if you do the step 1 right and do continuous assessment on those, more often than not, the kind of issues that are faced by organizations would be reduced. So there is a need to have reliable information, and so you need to check compliance with various regulations like the OCC, FINRA, FFIEC. Also, you need regulatory alerts from real-time data providers like Dow Jones, for example, and you need to define agreements and SOPs and assessments. So with access to information on politically exposed persons, relatives and close associates, global sanctions and official risks at special interest persons, global state and owned companies, adverse media and entities, as well as the country corruption index, which is updated by the government on an yearly annual basis, and also as a part of the technology provided by MetricStream also on an annual basis. It helps you assess the changes of the corruption and level in various organizations and conduct specific type of assessments based on that, like privacy of data. Ethical related assessments can be triggered based on changes to this. So once you have the right set of information available, where you have onboarded your supplier, you've done sufficient amount of segmentation on the suppliers, leveraging the various types of assessments, you need to continuously monitor your third party. That means you need to identify and monitor critical third parties for which you want to review alerts. So while you onboard third parties, the technology should be able to provide you with appropriate types of assessments, like I told, the location, the geography, the country, and the various level 1 type of assessments. Based on that, you define your third party as a critical or non-critical and continuously monitor them with alerts from various providers like Dow Jones, or you subscribe to third parties for review and actions, or you provide risk ratings in risk tab for each risk categories, and you log issues for key findings, or you also conduct subsequent assessments on your third parties. So the need of the hour is to simplify third-party risk assessments. And there are various types of third parties that an organization would face. There would be supply-side third parties. That is, in this case, vendor risk assessment continue to confound many companies. Even while they say they're getting a handle of the supply chain risk, it is still at the top priority of their list. And for the service side, the companies lack the ability to extend risk assessment into subcontractors and tend to focus on the easiest risks to qualify, such as financial viability or business continuity plans. But a lot of other aspects are hidden. On the customer side or the demand side, the decisions are made on a supplier based on single delivery channel or multi-delivery channel. And often companies lack the infrastructure or technology to have adequate monitoring in place to handle the volume of the demand-side relation. It is common for companies to rely solely on self-reporting of information, and that is our observation in the past with our interaction with various organizations. And therefore, the need is to simplify third-party risk management, where a single tool can help you store and manage survey templates and questionnaires with appropriate version controls, and multiple templates can be used depending on the supply category, tier, as well as the compliance risk management. There is a need to do communication and follow-ups, which can be done automated through emails. I spoke about the workflows in the beginning, which help you review and approve surveys and self-assessments submitted by the supplier or various individuals in your organization. Now, with access rights defined and the score tabulated, consolidated based on the weightage of each department that your organization sees, you get a consolidated score and the performance status of your supplier. Of course, there should be the technology tool should be able to have the algorithms to automatically score and rate responses, which I spoke about, and capture issues and initiate corrective actions based on the assessment finding. So a lot of organizations help you find this entire risks, but you need a single tool to also correct those issues that you see in your organization, that you see in the suppliers, and that is where a streamlined set of process flows and a streamlined set of technology helps you bring about visibility and awareness in your organization as to where are the risks that your organizations are facing and what actions have been taken to correct them. Now, it's not just when you score a third party or a supplier, you need to assess the internal performance, you need to get the external updates, and based on that, you need to have a third party risk score on various parameters like the risk relationship, performance, the kind of supply chain disruptions possibility, that is the business continuity plan that are there, validating the business continuity plan, what is the financial health, environmental indicators. So a technology tool should be able to capture all these types of information, internal and external, with scoring across each of these sub-parameters and give you a consolidated score based on a pre-built algorithm to help you assess and build on a supplier relationship. As Sherry mentioned, it is essential to evaluate the performance of the supplier as well. So the performance can be evaluated through scorecards and ratings based on categories and groupings of quantitative and qualitative metrics. So technology tools should be able to capture various types of metrics, whether they are qualitative or quantitative, and have wages and the capability to manage various types of scoring methodologies across various departments, and then on an overall basis, group them up. So a consolidated supplier performance matrix with real-time updates ensure that the action is taken immediately. So once there is an awareness of these type of risks and performance slackening of performance of supplier, you can immediately take action. You can also incorporate data from various modules such as supply corrective action, audits that are conducted on the supplier inspections, etc., and assess how suppliers are improving over time. So a successful third-party risk management program has an appropriate level of risk measurement and monitoring, performance measurement and monitoring, and incident tracking. So evaluation of the value received from and of course the evaluation of the value received from the relationship. These activities are important for determining whether and when to renegotiate the terms of the agreement. And before you renegotiate the terms of the agreement, it is essential to audit physically, as Sherry said, the various sites that the supplier is doing business with. And with appropriate technology and the appropriate types of rights where you can access the audits on your phone or your tablet and check the supplier status and automate this entire workflow where you do the assessments offline at supplier status and send it back for review and approval in an automated fashion. It becomes quite simplistic to then do a root cause analysis and corrective actions and track those findings through closure. So the companies that are most successful in this auditing and monitoring function are those that work to enhance the data that they have about the relationship. Okay, I guess we've run out of a little time. I'll just take a minute to just brief about MetricStream as well. So MetricStream has over a lot of customers across various types of industries, and we have about 350 enterprise customers, and we have 1,800 employees. We provide solutions for not only third-party management, but also other elements like product compliance, quality, EH&S, and sustainability, and all of these are connected together to provide holistic information. We are an integrated governance, risk, and compliance organization, which provides better business performance. That's it for me. Thank you, everybody.
Thank you, Sherry and Swapnil, for a terrific event. All questions submitted during the event today will be answered via email. We did capture everyone's questions, and please look forward to having your questions answered by our presenters. Attendees of today's event will receive an email in the next 24 hours thanking them for attending this web seminar. The email will contain a link to your CEH certificate and the archive of today's event. In order to access and print the CEH certificate, you must be logged into ISM's website at www.instituteforsupplymanagement.org. We appreciate your time and hope you have found this webcast to be a valuable experience. Please take a moment to complete our survey following the webcast. We appreciate your feedback. Enjoy the rest of your day.